Okay, let's talk more about the markets right now as we get set for a big week of earnings. Joining us right now is Ed Yardeni. He's the president of Yardeni Research. Good morning to you.
Good morning.
We've been debating what the Fed's going to do. We've also been debating how some of these earnings are going to turn out, though I think people are a little more optimistic than they had been 2 weeks ago. Where are you?
Well, I've been consistently optimistic, actually, about this bull market that started October 27th of 2022. So far, so good. I think we're getting a little bit stretched. Need to have some consolidation. But earnings, I think, are going to be fine, especially for the quality names that Mike just went through. And at the same time, we've got some other issues that are becoming maybe more relevant, and that's the ongoing conflict in the Middle East. And, of course, the Fed has to deal with these issues just the way investors do.
So given your optimism, layer on the Middle East, it seems like the market is taking it all in stride. Should it be?
Yeah, I think that's absolutely correct. I keep watching the price of oil, and it has come up somewhat. But there must be a tremendous amount of oil out there available through all sorts of different channels. At the same time, it's important to realize that this notion that the U.S. had to have a recession to bring inflation down turns out to be incorrect. What really happened is China has had a recession, a property-led recession, and Europe's been in a recession, so the demand for oil has been weak. And so that's offset some of these Middle Eastern concerns.
When you think about what the Fed is going to do, how important is your optimistic take to the idea that the Fed is going to cut potentially in March? Is March too early?
Yeah, I think I'm a contrarian on this issue. The markets have been expecting 4, 5, 6, maybe 7 cuts this year, and sooner rather than later. I think the markets have backed off a bit on that. But I actually would like the Fed to hold off easing at all. I think the Fed has actually not only tightened, but actually normalized. Interest rates are back to where they were before the great financial crisis. Investors are finally getting an appropriate return in the money markets and in the bond market. And the economy has demonstrated that it's resilient and it can live with them. So I'd like to see, you discussed capital markets in a previous report here. I'd like to see the capital markets work more efficiently and let the bond market determine where capital should go.
So you think you just leave them as is and the market will still go up at this point?
Well, I think if you leave them as is, and it's clear that one of the reasons for that is because the economy is doing well and earnings are coming in strong, then I think it's a good trade-off. But I don't think there's any rush for the Fed to ease right away here. They got the risk of the Middle East creating a 1970s scenario to 2 energy shocks. Right. And then if they ease and become too dovish, they'll get a 1990 scenario, which is irrational exuberance. So I think the smartest course for them to avoid these kind of risks on the tail risks is to, in fact, do nothing.
I'm loath to ask it because it's just a cliche of a question at this point, but are the Magnificent Seven still magnificent?
Some, yes, some not so much. It's starting to be a little bit of a more specific story for each individual stock. Tesla has obviously some issues right now, but maybe it's not 7 anymore.
So what is it, and what would you buy and what wouldn't you touch?
Well, we did see a nice rebound since late October of last year in the small cap and mid cap stocks, which made a great deal of sense to me because these are really cheap stocks compared to the S&P 500. And there are lots of good small and mid-sized companies that should do well in an environment where for the 3rd year in a row, we're not going to have a recession, as has been widely anticipated. So I think that's a good area to be. I would stick with technology. I would stick with financials. I think energy has to be overweighted as a hedge against the Middle East craziness.